like very detailed music. I like the music, Eddie. You did a good job. It's very cool. I'm digging it. Well, we're going to be talking about the Fed, because they met on Wednesday. They paused some rates. And what does that all mean for the real estate market? I have a guest this week. His name is Ryan LaRussa. You guys probably remember him from past streams beforehand. He's much more equipped to talk about this and what this means for mortgage rates because he is a mortgage lender with GMFS Lending. And we got him right there. Hello, everybody. And when y'all hear his voice, I want you to put in the chat who you think he sounds like. What famous person do you think Ryan LaRussa sounds like?
All right. Thank you so much. I'm excited. What an intro. What's going on, guys?
No, not much, my friend. I hope that, are you guys seeing, this has been a volatile last few months. Interest rates haven't really crept down where people were hoping they would be as late, which was in the 5s. Didn't see it. Are you guys still writing as many loans as you did last year at this time?
Yeah, that's a great point. It's a great question. I'll be honest with you. This year has been phenomenal. I always try to go back and in my business, look at quarter by quarter. And if you think back, I want all of us to think back December, January of where we thought this year would be, right? This year is supposed to be a very flat, very not much of appreciation type of year, maybe even some negative appreciation. And we've been super busy. So just to kind of catch you up, going all the way through the month of August, I'm blessed to have a small team that I operate with here in Baton Rouge, and we do business in about 9 different states right now. But we've helped over 181 families through the month of August, and the month of September looks to be exceptional as well. I'll tell you, it's been a different type of year. But we've helped a bunch of folks. And I tell you, despite what you might hear, and I know we all hear because I hear it, with all the articles and things like that, the market here in Baton Rouge and some of the here, Mississippi and Texas, we've been really, really, really blessed to have a very big business. And, our price point's different. So I think that has a lot.
I was going to say that.
We have one. I have a property right now that I had in my portfolio that I was selling just because it was kind of right outside of the little range of where I want to be right now. I want to roll into some commercial real estate that I see some opportunity. A $240,000 house, and we've had multiple. We put it on the market Friday at 4, and I think we've had at this moment 4 offers. So of course it's highest and best at this point. But I mean, you don't hear about that. We just hear about the negative news. So to answer your question, have we been busy? Have we been writing a bunch of mortgages? And that answer is yes. One thing that I think came out, it's been about 18 months, and I spoke about this a couple of weeks ago to a group, is the 2-1 buy down. We've been doing it's been crazy. So every month, I bet you, 5 to 8 families that we helped were able to use that 2-1 buy down in order to lower the rate to get that folk, from maybe the 7% range down to a 5. So that's a big deal. So we've been doing a bunch of that. And that's what I've been seeing.
All right. Well, last week, and I mentioned this because you saw the same group that I saw when we went and did our continuing education.
Mm-hmm.
And I was surprised by the vibe in the room of panic between all the real estate agents.
Right.
I did talk to, a couple of agents that had done a couple foreclosures, which actually surprised me.
Right.
Why do you believe that so many agents are in a moment of panic at this point? Is it because there isn't as much supply, or do they think that the housing market is going to crash? What do you think is why were they so anxious?
Yeah, that's a great point. I think that the anxiousness, we're in a world where we want things like today, like now. If I want something, I want it right now. And that's just not the housing market that we're currently in. There is much more inventory now starting to come on the market. I talked to a lot of agents that are having a lot more opportunity to have more listings right now. But I think the reality of it is there is not a tremendous amount of inventory, which creates panic for a lot of people. But we all forget. And again, I know I started when I was like 8 years old in the mortgage business, but this is September 11th was my 22nd year in the business. Okay. And so here's what I know, that it typically is a 60 to 90 day process in order between the time I get an application and the time I close on that house is typically a 60 to 90, and in some cases, even 120-day process. Well, the last 3 or 4 years, that's not been the case. It's been literally here now, boom, 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 boom. And so I think a lot of us have forgot that prior to 2018, 18 and 19, that market was kind of there. We go through COVID and everything was flying off the shelf. Now you're back to this super tight inventory. And I think that's caused a lot of panic for a lot of folks. I really do. But I tell you, the last 3 or 4 years, you are paying an absorbent amount of price. So let's go back to price real quick. I don't feel that price is going to go down. Here's the reason why. A lot of demand, and I speak about this a lot because it's important for people to understand. Like every single week, my little bitty old team of 3 or 4 loan officers that I get the pleasure of doing business with, we average 20 to 25, 30 applications a week. Okay. So if that's me in little old Baton Rouge seeing that, I know what's going on in the surrounding areas because I have my pulse on that. You have a lot of people fighting over the very limited amount of supply. And so I think that has something to do with the anxiety that a lot of people are feeling. There's just not a whole lot out there, Ryan. I get it. But you're starting to now see, and I think the next 3 months, you're going to see a lot more inventory hit the market. Like this little house I'm talking.
Higher price though? Higher price inventory?
No, I think it depends on the market that you're in. If you just kind of look around, I'm in again Baton Rouge, and look within outside of an hour and a half of where I'm at here in Baton Rouge, you're starting to see now a lot more lower price inventory coming available. Like this house I'm talking about, there's a lot more agents now saying, hey, I've got one coming up next week. They're reaching out to me. Do you have anybody? And that answer is yes. The difference is those houses are not staying long because you still have the same amount. I put a buy versus rent calculator out there on my business page. But even at a $275,000 price, and I look, I know we're talking to a lot of different markets on this podcast, but in my area, 250 to 300,000 is definitely attainable. It's not all $1 million, $500,000 houses. Now, different segments sit longer, but if it's 270 or less and it's priced right, it's gone. I'm just telling you, it's gone super fast.
Yeah. Well, we get a $4 super chat here, and it says, when do you think rates will go back to 3%? And this is a good question to segue into the fact that the Fed did meet on Wednesday, and they're pausing rates right now. What does that mean for mortgages and people that are trying to find a home right now? What is that going to mean for the next time that they meet?
Yeah. So they're going to meet 2 more times, right? Between now and the end of the year. Here's my take on it. And I'll tell you this, I'm no predictor of rate. I've just been doing this for a long, long time. But here's what a lot of the analysts that we follow are telling us. The reason why they didn't raise them this particular time, they want to kind of see, what to do the next 2 times, in my opinion. I do believe that there's a good chance that we'll see a 0.25% more hike before the end of the year. Okay. I do believe that. I think this pause here, I think it was definitely needed. I do believe that a lot of your job numbers, if you go back and look at the job numbers, the last 2 job reports that have come out, they go back and re-up those numbers or reanalyze those numbers, and there's been massive corrections. So I do not think the housing market is as bad as what they say it is, and I think that the job market is a lot softer than what they think it is. Hence, the last 2 job reports that have come out, they reduced those numbers. As that continues to happen, you're going to see mortgage rates, and not just mortgage rates, rate in general, come back down. The 3% comes up often. I personally do not believe that we're going to see 3% interest rates again for a long, long time. Could it happen? It could. I think where we believe, and a lot of the analysts that we believe feel that rates are going to be, is that mid to upper fives. And I think
Mhm.
you could see that a lot faster. And again, I'm not predicting rates. I'm just telling you, I think the first quarter, second quarter of next year, you're going to start seeing rates come back down. And it would not surprise me third and fourth quarter of next year if you saw that mid to upper 5%. Here's the main reason why. We all are consumers, okay? And if you just think about it from a logical standpoint of where consumer debt is right now, it's at the highest it's ever been. And that affects not just mortgage rates, it affects your credit card payments, which we see this every day. And I've seen this for a long time because I do this and have been doing this education for a lot of clients. If you had $3,000 on a credit card and that payment was a couple $100 a month, say 6 months ago, that payment's now almost doubled. Okay.
Mhm.
So do I believe that the Feds, speaking of rates, are going to allow rates to continue to climb and climb and climb? I don't. These credit card companies, these folks that are charging these higher interest, look, we're benefiting from you and I's money sitting in these high interest yield accounts. So I tell my clients all the time, especially the ones that want to put a lot of money down. I'm cool. If you want to put down a bunch of money on a house, I'm okay. But there's ways to hedge against it. If you put your money in a high interest yield savings account, it's making 3.5 to 5%, and it's costing you 6.5 or 7. It's not a bad place to be. I don't like where mortgage rates are now. I don't think they're going back to 3% anytime in the near future, if ever again. I believe that we were blessed with a wild time due to the circumstance. I believe rates are going to be in that mid upper 5-6% range though next year. I personally believe that. And that's because of what I just talked about. You have to understand that it affects more than just housing. It affects a lot of things. That's my thoughts on that.
So the Fed over a year ago said that they were trying to remove as many, like first they said like uh, they kept saying, well, we want to remove 1 million jobs. Now we want to remove another 1 million jobs. Is that the goal? And if that's the goal, will that make home prices cheaper because mortgages will be cheaper? Or is it going to make it home prices cheaper because they're hoping that a bunch of people don't have a job and they'll have to put their house on the market and they'll take a loss?
Yeah, well, the whole thought about taking a loss on a house, I mean, I think that's indicative to the market that they're in. I know this from the guys that I see and the clients that I've helped. It is unbelievable the amount of equity that people are sitting on. And I know you just mentioned a few minutes ago about the foreclosure rates, and yes, there's some that are going to come out, but I think all the guys that are out there are talking about these huge areas or huge pockets across the country that we're going to have this huge foreclosure rate. I just don't see that. The job market itself, I think it's much different now than what it's ever been. People can make money a lot of different ways. I believe that if you go back and you study some of these, I don't like to call them. I just call them goalposts. It's football season, so that's where my mind is. So the goalposts continue to move with some of these. Hey, I want to put the target rate at 2%. Really? Like if you look at inflation and where it is and all the other things that the Feds have done and the timeline that they've done them, inflation has curved back down a tremendous amount. The lag effect that we're seeing, we just haven't reached there yet. That's why I'm
Mhm.
saying the first quarter of next year, you're going to see like that target place that they want to be. I think you're going to be there a lot sooner than what you think, because I don't think the job market is as strong as what they continue to say it is based upon. Look, I got 2 loans right now this month. Okay. One a high executive, one not so much, but one that made a couple $100,000, lost his job in the last couple of weeks, therefore is no longer able to purchase a house. Uh,
Mhm.
thank goodness he didn't buy the house, because in my opinion, that's not like a fillable job. You're not going back and filling that job right away. And then another one, $65,000, $75,000 job. Guy lost his job. He's going to find another one in that same profession. But you're starting to see a lot more of that. I think that hence the fourth quarter of this year, you'll see those numbers come down quite a bit, which the Feds are going to have to counteract by that. So I said another 0.25% by the end of the year, but it wouldn't shock me if they completely paused it, letting the information that we just talked about catch up. We haven't had that, you hike rates this month. Well, you don't see that for 60 to 90 days of how that really affects the interest rate increase. But one of the things that I like to tell everybody, this is key, when the Feds increase the federal funding rate, that actually helps the bond market, which helps mortgage interest rates. Okay.
Right.
So when they say, how we raise the rates a quarter, sometimes we see mortgage rates improve. Right now, mortgage rates have been kind of stale or stagnant for quite some time. Yeah. I mean, we've been seeing mid to upper 6s to 7% pretty much almost all year. It's been that way. But going back to what we just talked about earlier, seller concessions, okay? On this $275,000 example I like to bring up, the seller in the last 4 years, they weren't paying any closing costs on a $275,000 house. Zero. Guess what's going on right now?
Closing costs.
You're seeing $7,000 to $8,000 of cost, which would help us in this case buy the interest rate down either permanently or do a 2-1 interest rate buy down. So that 7% rate goes down to 5 the first year. In the second year, the rate is at 6. And in the third year, it stays at 7. But for the next 24 months, you know exactly what you're looking at. It's a fixed interest rate. And so that takes that guy that was paying $1,800, $1,900 a month in rent to, hey, I'm paying $2,000 on a house payment right now, but I own this house versus paying rent. So we've been able to use that, and that works on any product. We've been able to use that as a cool counterbalance to use this closing cost assistance in order to make that person a homeowner, which has been really, really neat to be able to see.
Yeah, well, I know that everybody's been panicking, and then when they pause the rate, the thing that has been my whole concern even before the pandemic started was the cost of housing had gone up so much. There were so many people that couldn't afford a house that would have been able to afford a house with the median income for that specific area. Then that problem exploded because there wasn't enough homes for the median income family to be able to find a house because the home prices had gone up so much. I think the part that most people can't wrap their head around is that they see the titles, the thing that says, less homes were sold in the month of August than a year prior, or they see that and they're like, oh, that means home prices have come down, but that's not the case. So home prices have continued to go up. And even when the interest rates go up, because normally when interest rates go up, home prices come down. That has not been the case.
That's right.
What do you think is the reason for that? I have my own theory on this, but you can give me your theory as well.
I'd love to, let's collaborate about that. But here's what I know is, we all get, and myself included, like I turn on the news and I hear, oh God, the median home price is X. Okay. Mm-hmm. Well, that's relative to the market that you're in. Here's what I do know is that when I started, dating me back 22 years ago, rates were in the 7s. Okay. Mm-hmm. We were at that point doing alternative subprime mortgages. That's how it started, right? Wrong or indifferent. But mortgages were in some cases 3 to 4% higher than that. And I'm thinking, I didn't know any better, but that's what it was. And people were buying homes. There's a reason why there's less sales is because there's less product out there, right? And so if you go back and just study the numbers and you look at it and say, okay, right now, and I didn't check it before we did this call or this deal, but 800 to 900,000 units, of which about 30% of those are new construction, which means they're not even ready to buy. That's all that's available nationwide. Mm-hmm. And it's just, there's just not enough out there. Again, going back to what I know, if it's priced right, it's selling exceptionally fast. Okay. Now there's different pockets that are selling faster than others. But here, from what I see in the clients that I help, the first time home buyer now has a chance, right? The first time home buyer did not have a chance the last 3 or 4 years. So I like to give, just information that I see, because if you hear, well, nobody can buy because it's unaffordable. Well, that's not true. That's not true at all. The first time home buyer couldn't buy the last 3 years because they had so many people buying up property, which I know you spoke a lot about, and it really hurt the affordability, and it hurt the first time home buyer in a big way. Now I'm seeing those guys back. I think in the month of maybe July and August, it was somewhere around 28 to 33% of the purchases were first time home buyers. It hadn't been that high in many, many years.
Yeah, if anybody would like, you can pull up like an Adam report, you can pull up Fred report, and all you have to do is just type in the old Google webs, the rate of new construction being built in the last, let's just say 30 years. So there was a huge spike right before the last housing crash that we had of new construction. I mean, everywhere there was a neighborhood.
Right.
After that, we got that all straightened out and we moved forward. Home builders didn't build homes like they did in years previous. And the homes that they were going to build were going to be the ones that made them the most amount of money, because the cost to develop a piece of land for a development is so much more than it ever has been in history. The amount of red tape they have to go through is so much more expensive. So we're stuck in this spot where the only new construction, the good portion of the new construction that's being built, not just in Baton Rouge, I'm talking all over the United States, is for people that are buying their second or third home. It isn't that first time home buyer. And a lot of the first time home buyer homes, and this is the part that scares me, is that if you go like into areas that are like Phoenix, Arizona, and some of the bigger cities, the building that you see that you think, oh, wow, finally they're building first time homes. They're not first time homes. There are homes that are being built specifically by an investor just to rent out. So they're built to rent housing. And I know you probably laugh, but I have this thing that I believe that there's a good portion of people in Wall Street that are trying to turn as many Americans as possible into renters. They don't want people like my kids' age and younger. They would rather them rent from them for the rest of their lives than ever own a piece of real estate. And as I see more and more of these developments popping up, because like you didn't see them outside of like little Austin, Texas, or San Antonio, and then all of a sudden there's 3 new of these developments, and then they're all over Phoenix, Arizona. Do you what do you think about that? Like, how will this affect people in the future? Or do you think it's an issue or a real issue, or do you think this is not a problem? Because before you answer the question, because in my brain, if they own so much of these developments that are all first-time home buyer type sizes, and these people are all renters, then they dictate the price of rent in the area. Sure. And to me, that's a big freaking problem. But now you throw in your 2 cents.
Yeah, no, I think it is definitely a big problem. And look, and I talked to the group about this a couple of weeks ago, and then I talked to your viewers about this before. As somebody that's been doing this for a long time, and I own property as well, I just think about our small portfolio. That rent has increased and continues to increase due to cost of taxes, cost of insurance, and things like that. So people that come to me and say, there's an article, I think you guys may have it, or I'd sent it your way. If not, we need to talk about it. Realtor.com talked about, hey, it's better to rent than to buy. This was last week or whatever. So my question to that would be, is it really? So I think, look, for certain folks, they're renters, and that's cool. Some people want to rent. That's what they want to do. Right. This is that little example that I was showing you, or we were talking about. So let's think about this. You buy a house, $275,000 house. You put a very minimal amount of money down. You can put as little as 3.5% down. In some cases, we do 100% financing, but that payment's principal and interest $1,650. Okay, 1647 right here. If you throw in there property taxes and insurance, 340 bucks. And I even say in there, it's going to cost you $114 a month for maintenance and repairs. Okay. Which if it's new construction, that's not true, but let's just throw it in there because I think I like to give myself wiggle room. At 7% interest rate, you're talking about a $2,100 a month payment. Okay.
Mhm.
I know in Baton Rouge where I live, it's very difficult to find something. Ascension Parish, where Kristina lives, it's very difficult to find something in that $1,700, $1,800, $1,900 price point where you want to be. And if that's the price today, do you really think that the price of rent? Now, look, I know that this is debatable. Well, rents are going down. Well, if rent comes down, somebody that's renewing their rent each and every year, let's say you have a good tenant and they stay and everything like that, you're not going to keep their rate the same. The landlord at some point is increasing that rent. So always show in let's say 5 years, 7 years, that rent could be a couple hundred more dollars, but everybody just focuses on the here and the now and today's payment. I understand buying a house is a sacrifice. It's a financial sacrifice. But when you look down, scroll down a little bit, let's talk a little bit about the appreciation. I do everything based upon a 3 to 4% appreciation rate. Okay. I can tell you it's been way, way, way higher than that. But let's say you bought a $275,000 house and you got 4% appreciation. In 7 years, just getting 4%, that house is up $86,000. That's insane. Okay. Let's think about all the just what I led off with the beginning of the conversation. At the beginning of this year, everybody was saying this was going to be a down year in real estate. There was going to be zero appreciation. And
the housing crash bros, the housing crash bros were all over the place. It's all going to fall about. It's going to go down 30, 40%.
BlackRock, Zillow, Case-Shillers, all those guys have already shown all the way through 8 months, almost a 5% plus appreciation, which is insane. I mean, so last year, I think the annualized across the country was somewhere double digits, 15 to 18%, depending on the market you were in. Again, trash all that. That's why I'm saying just give yourself a 4% appreciation and you're up in 7 years, 80 something $1,000. So going back to, I'm worried about the rent prices and things like that and all. Yes, because if you're not focused on not just the payment's one thing. You got to look at every single area of the home ownership and the benefits of being a homeowner. Is it for everybody? Is it for everybody? No, it's not. Not everybody needs to be a homeowner. I firmly believe that. Look at this. If you, to the right-hand side, in 7 years, just paying the normal payment, you've paid over $21,000 down on the balance at 7%. If that rate was 5, that number's much higher, right? And so you start looking at some of these numbers. I even say, okay, if I hated being a homeowner and I took out, Ryan, I want to sell this thing in 7 years, and the real estate agent charges between 5 and 6% commission, we back that out. Show them what they're going to net on that transaction right there. Eddie, if you can scroll back out, that'd be great. Yeah, so you really don't like being a homeowner, and at the end of the day, you sold it in 7 years minus the real estate commission. You made $92,000 putting a small 3 or 3.5% down. Those numbers are incredible. Again, I'm not telling you that everybody needs to be a homeowner. I just think that the education piece is where our society is all about the here and the now. They're not looking at the total numbers of where you could be. And if you go back and you look, yeah, prices are up. Do I think prices are going to come down? I really do not. I'll use a couple areas around Ascension. Let's go Ascension Parish where you live, Kristina. There's a subdivision right off of Highway 42 that I have done a tremendous amount of homes. Probably done, I don't know, 15 to 18 houses in there right now. That housing market right there in that one subdivision is $500,000 houses. They're not moving. Okay. They're not moving. And the reason why they're not moving, it's not because they're bad houses. It's because somebody that's going to spend $500,000 is more than likely your second home or third home. And that person is saying, I would like to move, but I really don't have to move, right? So that's a huge example of, well, Ryan, you said that the housing market's hot. I said that it depends on the pockets that we're in. If you go anywhere else in Ascension, let's call it $300,000 to $400,000 price point, those houses are selling. Why? Well, Ryan, well, why is that? It's because it's a different client buying something in those different pockets. You got to also look at the moratoriums. Some of these areas, Ascension's another great one. They've had you can't even get a new development approved to build. So if they put different moratoriums and things like that in, do I really believe that the price of homes are going to go down? Limited supply, a huge amount of demand. No, I don't see that. And I don't see rents just to go drop tomorrow. I just
absolutely not.
We're not going to see that.
No, not on rents. That's for darn sure. We have like a ton of questions that have come in, and Eddie's going to be putting those on the screen. The only thing I worry about, another thing I worry about when it comes to housing is, I mean, I'm sure you see your insurance probably went up, your homeowner's insurance. Mine certainly freaking did. On my rental properties, it's gone up a lot. And then, you got your property taxes going up. So what were you going to say?
Yeah. So real quick on the insurance piece. And I know that this is not just in Louisiana, because like I said, I do business in quite a bit of different states. Guys, that's one of those things that does affect I own a home as well. It affects my monthly payment, right? And so think about it from an investor standpoint, okay? An investment property, the insurance is always more expensive than a primary residence. So again, going back to
mine doubled.
Yeah, exactly. Mine got dropped, okay? Progressive dropped
twice. We got dropped. Twice we got dropped, and then
so think about that. If you're continuing to rent and you're like, okay, well, I'm really not sure what to do. Those are also factors that the landlord or whoever you're renting from can't control. But if he gets dropped and he has to go pick up another policy, that policy more than likely is going to be higher than the current one that he had. That's just reality of where we are. The same gallon of milk 3 years ago that cost you $3.50 or whatever, $3 is costing you $6 today. So, I mean, I don't see things from that standpoint just to continue to come down. So you got to be thinking through these type of things. Hey, if you want to rent, I think there's a season for everybody to do that. I rent it. I've rented.
Everybody's rented at some point. Yes. I always tell everybody, if you don't plan on living in the house for 7 years, don't buy a house.
No.
Like, just don't. Shirley said, keep up the great videos with the $1.99 super chat. Eddie, you put a question on the screen. There we go. Question: if corporate investors were to sell their single family homes all at once, would that solve the inventory crisis? So if all of the institutional investors got on a board meeting call, Zoom call, and said, you know what, we're going to drop everything, we're just going to pull the plug, would that solve our inventory problem?
Oh man, I think that's I love that question. That's awesome. Let me flip it. Why would they?
No, I mean, but we're playing imaginary. So an imaginary world tomorrow, BlackRock, Blackstone, Invitation Homes, Homes for Rent, all of them got together and said, we're going to put everything on the market. There would be some things that would happen. There would be some areas that would be affected greatly by, a matter of fact, that probably helped the prices, in some of those areas, but it wouldn't help across the board. It wouldn't help every area across the United States, because investors don't necessarily have like every area cornered as far as inventory is concerned.
Absolutely not. And I think what I do believe what would happen right there, my honest opinion, is it would drive prices even more. Okay. So that would be, I think that I would be worried that it would drive prices up, because I promise you one thing, you're going to see this. And we talked about this 3 weeks ago in another mastermind group I was in. For every 1% interest rates go down, 5 to 7 million more people hit the market. Okay.
Right. That's when mortgage applications go up too. Like soon as it goes down like a half a point, it's like all of a sudden, people come out of the woodwork.
So I think that would cause, if rates go down and there's limited inventory, and then all of a sudden you have this surge of houses that
Supply.
hit, you're going to have people that are going to fall all over theirs. Because here's the number even today of the facts I just gave you, about 30% of the home buyers were first-time home buyer. You still had 15 to 20% of investors buying houses. So investors are not going to stop buying houses because they understand where things are headed with rents. Rents are not going down. And so if
No.
I'm an investor and I'm buying property and I'm looking at it like I have this money over here on the sidelines, not doing a whole lot, and I've got this appreciating asset that we just showed, that it's still doing the same thing for them as an investor as it would be you as a home buyer if you look at the buy versus rent calculator, because you're still gaining amortization. And then you've also still got the appreciation as well. So if I've got both of those working for me, I'm going to continue to buy. We're never going to eliminate that. So I don't think that would fix the housing supply problem if all these investors all of a sudden just said, hey, you know what, we're out. That would never happen because they're in the business to make money and they understand the profits that they're making.
Well, we have another question from this kid right here. I say their screen name the same way every time. It says, do you think the Fed is considering lowering rates to benefit corporate buyers, not necessarily families?
I don't think that has anything to do with it, because you've got a lot of folks right now that are not buying property because the numbers don't work from an investment standpoint. Okay. So if you called the bank tomorrow, just test me on this. Call your bank tomorrow and say, hey, look, I'm looking to get a commercial loan, because most of the properties that are bought, like what we're talking multifamily, if you're talking multifamily, are some of these big investors going in there buying multiple properties. They're getting a commercial style loan. We do these loans for investors, but a lot of them are bought based upon a commercial loan. That commercial loan's 8 to 10% right now. Guess what? The numbers don't work for them to buy a $250,000 or $300,000 price, because once you factor in taxes and insurance and everything like that, the margins don't work. Okay. So by lowering interest rates, do I think that's to benefit the corporate? No, heck no. I think at some point they're looking at it saying, okay, we're about to have a big problem, because do you really believe that they're going to let these credit card companies, which that could be a whole nother conversation, just not collect their payments? They're going to make us consumers pay high interest on everything, not just your mortgage. So I think that has a big play. Credit card debt is a huge problem, guys, a huge problem. And so by lowering interest rates, that does affect consumer debts. It affects commercial loans, consumer debts, pool loans, home equity line of credits, mortgage rates. It affects everything. So I think we're starting to see the fourth quarters here. I think you've seen the job market not being now as hot as what everybody thinks. And I think in the fourth quarter, you're going to start seeing that come down quite a bit. Go back and look at the last two job reports and the corrections, 18 to 20% correction on the number. So I think they're going to pull rates back. And my concern with pulling rates back is you're still going to have the same limited amount of supply, which is going to drive prices higher.
Yeah. So Americans have an absolute mountain of credit card debt, over $1 trillion.
Yeah.
But they had said that that we've tapped out. Most Americans have tapped out of their personal savings.
Yeah, absolutely.
And they're living off of credit cards, and they have been for quite some time. Then you add on top of the fact that everything's more expensive.
Yep.
And then you say you did have a mortgage. See, I still kind of think there is a recipe out there for this all to come down. I know people are looking for that silver lining, especially if you're trying to find an affordable home and they want it to crash. And I get where you're coming from, but I don't want to see families suffer at the same time. If the jobs market isn't correct, and that people are losing more and more jobs, is it possible that we see a surge of homes hitting the market maybe next year if if like things are going haywire, like they can't pay their credit cards, they go into foreclosure, is it possible that we see more supply of homes just because of desperation?
You certainly could. And I think that I've been preaching that for a couple of years now. People tell me, oh man, well, there's going to be this huge foreclosure wave, this, that, and the other. I'm like, guys, look, more people now are sitting on more equity than ever. If I
That's
lost my
it.
job next week, and I'm living in the house, I don't want to sell my house, but that's an option. Think about this, flip it. If you're renting and you lose your job, what? You got a big problem, right?
Mhm.
Because you got no amount of income coming in, and you got to go live. You got to pay to live somewhere, is my point. All of us,
Mhm.
whether you rent or whether you stay with family, or hey, look, you got a mortgage. And so I believe that yes, it could create some inventory, but if the majority of Americans lost their job, they have a route because they have so much equity built up in their house. They could sell their house, take that, pay off the debt. Right now, we're probably getting 2 or 3 phone calls every single week out of the applications that I talked about earlier of, hey, look, my mortgage is at 3.5 or 4%. My credit cards were at 15 to 18%. Now they're at 28 to 35%. I
Mhm.
can't continue. My kids are in private school. I can't continue to go down this route. It's killing me. So they're taking
Mhm.
some equity out of their home, not all their equity. That's the big difference. You can only get about 80% of the amount of equity that you have in your house, but they're doing some consolidation to help alleviate that, right? And
Mhm.
so that is another benefit. Going back to people ask me all the time, can you explain to me? I know you've been on this a long time. Give me some benefits of home ownership. That's one of them. You
Oh,
know,
I always tell them that.
yeah, you know what your payment's going to be. You know
Mhm.
that you can gain
Pretty much.
equity. Is there a guarantee of gaining equity? No guarantee. There's no guarantee of putting your money in the stock market and making money there either.
Right.
But the reality of it is the smartest guys that we all know, Buffett and those guys like that, they put a lot of money in real estate because they understand the tax benefits. They
Mhm.
understand the stability of payment. Do I think right now that you're going to see some things come up with some investors that have property that are on commercial loans? I do, because those loans that were done 5 years ago at 4 or 5% are going to mature now at 9 or 10%. And their insurance went up and their taxes went up and their note went up. And so they're going to sell some property, and that's going to help with a little bit of in some areas with some of your inventory issues, but it's not like it's going to be this huge foreclosure wave. There's still
It takes a long time too. Like,
very long
if
time.
I always tell everybody, if everybody lost their job tomorrow,
Yeah,
lost their
six to
job
12
tomorrow,
months. Six
it
to
would take
12 months.
in on average, right?
Yes,
There's
on average.
you got to remember, if those people go through bankruptcy at that time, that's going to stall it. If they decide to, and if they get they go through divorce at the same time that they're getting foreclosed on
Yeah,
and filing that bankruptcy, it may be years before you ever see that house.
could be crazy.
And they bundle those and they give them to investors a lot of times before we ever see them too. So anyway, that's just, you got to put that in the back of your head if you're hoping for that in the future. If there's any other questions, Eddie, can you put them up on the screen? I saw some people saying that, uh, is this a doomsday channel? No, absolutely not. No, I was just, we're just giving some perspective. Matter of fact, I like, one of the things I can't stand more than anything is that for the last year and a half, 2 years actually, everybody's all of a sudden they're all Nostradamus. They're all predicting the crash. It's all crashing. It's all crashing. And that hasn't been the case. My biggest thing, my biggest gripe has been affordability. And it has been from the day I started this channel. I
Yeah.
mean, I talk about manufactured homes. That's not the most sexy thing to talk about when it comes to real estate, but I genuinely want to help people. And if anybody doesn't know, when it comes to mobile homes, manufactured homes that you see, a lot of times when you're see them in parks, they have a lot of predatory lending practices that are used against them. So I use my channel to educate people so they don't have those predatory lending practices happen to them when they go to purchase an
Yeah.
affordable housing option. So no, I'm not a doomsday channel.
Yeah.
I'm going to help you out channel.
I think that's one of the beautiful things about doing this. Look, I get asked to do a lot of things. I'm very careful about how I do it, and communicate. But guys, the truth of it is you've got to see it from all sides and angles, right? It's
Mhm.
easy. Fear sells. I get all that, but you got to understand the basic economics of supply and demand. You got to understand
No.
numbers. You know, I always tell people, my clients, hey, numbers don't lie. Let's put the numbers out there in front of you, and then you tell me if this makes sense for you of where you are in your walk of life. Hey, if you have no money saved and you're trying to go buy a house, I'm gonna tell you, no, it's not your time to buy. Let's go save up a little bit of money. Let's go make sure that we got something to where if we have a rainy day or if something happens, you're not going to be one of the statistics of, you know, losing your house or the foreclosure and all those other things. Let's make a good educated decision, but I'm gonna educate you on the numbers. And if you know the numbers and you make that decision, we're gonna help you walk the walk. So that's it.
Well, this was a great question. Sarah Mason that says it's Sarah Mason. It's my actual name. That's her screen name. I love that. Said they're looking for an affordable builder in Baton Rouge. By the way, because you actually had a builder at your little talk that you had that we went to. There is DSLD is a affordable housing builder. Who else? DR Horton's another one. Who's another one?
Yeah,
Level
well, there's a bunch of them in Baton Rouge.
Level Construction.
I've got a meeting tomorrow morning at 11 o'clock with a gal that's been building houses in and around this area. Leanne, I'm just going to leave her name at Leanne, but her name's Leanne. She's a builder. Her husband's an amazing builder, and they build in that $200,000 to $300,000 price point. Beautiful house, got all the bells and whistles. They're paying closing costs.
I was just going to say they're offering closing costs.
Yes. And so there's more out there than what you think, and that's just one. Willie and Willie's another good one. But I mean, there's a lot of folks. Alvarez does a great job. Level in some areas that have started doing some different things. But there's a lot of folks out there that are building and that are willing to pay closing costs and get you going and get you moving. Look, I mean, that's the reality. Yes, absolutely, Sarah. Great question. But yes, ma'am, there are certainly some in this immediate area that are building. And tomorrow I'm going in a meeting at 11 o'clock. There's a little development that qualifies for rural development and first time home buyers. It's in Baton Rouge. Prices are like 220 to 236. And this thing should rock and roll. It should
Where is this?
Super fast. Off of South House Ferry. And I'm trying to find out the exact. I'm going to that meeting tomorrow, but they're rolling on it. She asked me if I wanted to come and take a look at some homes, but I've done some business with her before. I'm super excited about that tomorrow because there's nothing more, again, and I've helped thousands of people, but in my walk and what I do, and I've been very blessed to help a lot of people. I love helping first time home buyers. It is so cool to be able to see somebody that's been renting buy their first house.
It's so scary though when you're buying your first house because you're really trusting in the people that you have hired to help you with that process, you know? And then you hear all these horror stories, right? So, I mean, how would you suggest somebody finding their very first lender and their first real estate agent? How can a first time home buyer even know if they're getting a good deal or if these, you know, all these people are working together to like screw them over, you know, like people tell me these stories and I'm like, I don't even know if that's possible, but like sometimes I think people create stories in their head because they feel like they got boned in a deal or whatever.
Yeah.
But how would you suggest somebody look for somebody?
Well, I think in today's world, and look, there's a lot of great lenders out there, but experience matters. The last 3 or 4 years, guys, I'm just telling you what I know. A lot of people did a lot of loans. A lot of those folks are now out of the business. A lot of real estate agents sold a lot of houses. Quite a bit of those folks are out of the business. Experience matters. You need to sit down with somebody that knows what they're talking about and that's working for a good, reputable company that's been around, that they've been in the industry for a while. Like that all matters because you know that they're doing it as a full-time job. I see this question from Sarah talking about kid going to LSU. Mine's at LSU right now.
Mine is too.
real life example. So I could pay rent down by LSU, which was crazy, nuts crazy. Okay. Like $1,100 a month in rent for a kid to go to college. That's insane. So we wound up buying a house. I put my son on a loan. I co-signed for him. We bought a house with 5% down. He's got
Mm.
him and 2 other roommates, and they're paying rent. And so everybody's happy. So those are scenarios to where you can make those things happen all day long if you have somebody that can educate you on it. Because the other option would be, hey, you could buy it as investment property and things like that. And you can still do that. It's just more money to put down. But there's all kind of opportunities out there for first-time home buyers, kids going to college, parents having to, hey, we got to put our kids through school, and I'm right there with you. So I just did this. I'm very well experienced with that.
So you put the house in your kid's name. He co-signed for it, or you co-signed for the loan for him to buy the house?
Yep. And he goes on there as the primary because he's living in it, which is true. And put 5% down. You can do that all day long. There's no problem with that at all. He's living in it, and you have a co-signing for him, which is me.
I will be talking to you for the fall of next year. I did not know that I didn't even think about that. That is pretty genius.
It's creative.
It is creative financing. That's why it's good to find a good lender. Yeah. And I always tell everybody, interview 3 people, interview 3 lenders in the area that you've heard about, you've heard that have a good reputation. See if you have a good rapport with those people. And you know, if you trust your gut, if you go in there and you feel icky, then walk the heck out. There's a million other lenders that can help you. That is exactly the same for real estate agents. If you feel like they're blowing you off and they're not answering their phone and they're like, just find another real estate agent. There's a million of them out there. And experience matters. So, we have a question. It says, what's the average length of people will live in their home? Isn't that about 7 years? It varies. I think at one time it was 5, then it went up to 7 again, because it was 7 to 10. Then it was like during the explosion, that was like 3 to 5 during the housing boom, that before the collapse was 3 to 5. Then it went back to 7. So now it's 47% of Americans have lived in their homes for 6 to 10 years. 35% of homeowners have lived in their homes 10 to 15 years. And hold on. The average length of home ownership is about 8 years. So yeah, there you go. 8 years. I always tell people, if you don't plan on living in your house for 7 years, don't buy a house. I say it all the time. They're like, well, what about a condo? Doesn't matter. Don't buy it. Don't buy it if you don't plan on living there for 7 years. You're going to be in better shape all the way around if you just stay in there for 7 years. Yeah. Even like when people were like, during when it was crashing, right? The housing market is crashing. The people that bought, when the housing market was crashing, after 7 years, they gained their money back. Yeah. They gained their money back. They were in the positive, and they were able to close on their house and get some equity out of it.
You and I have talked about this, Kristina, and you know this because you and I've been friends for a long time. But even during that time, as scary as it was, everything comes in seasons. Okay. And so I didn't like it. I lived through it. It was scary as hell, but it was for a season.
We worked together then.
We did work together then. We sure did. But it was for a small season. Just like this season that we're in today, it's not going to last forever. Just like I told all my colleagues over the pandemic, guys, I'm telling you, this is a one-off, once in a lifetime type deal. A lot of folks, there's been multiple polls out there too that people, hey, look, bought their house during the pandemic, sight unseen, all this, that, and the other. Somewhere between 25 and 35% of those folks that bought are unhappy with their house and things like that. So I think you're going to have some homes come back for sale there. But think of it that way, as in seasons. If you're renting right now, it's for a season. If you're a homeowner right now, it's for a season. I'm looking around this house that I'm living in. My daughter's about to go to college in 2 years. I won't be in this house forever. I've been in this house for 6 years. In another 3 years, hence to the average, I'm probably going to make a move and downsize. That's what it is. People are
when these kids are done, I'm downsizing.
There you go.
Like I'm done.
Yeah, I'm like, hey, look, I don't need all this. I love my wife. I love but it's upkeep. Right? A house is an investment.
Oh, upkeep. Hold on a minute. How much vacuuming are you doing around the house? How much adjusting are you doing?
I'll pull Chantel in here. She'll tell you. I'll vacuum. I cut the grass. I do all that stuff. I am committed to my house because I'm a little OCD if you didn't know that by now, but I like stuff clean.
You and my husband would get along perfectly. He's the cleaner.
I do
He's
it
the
all.
cleaner.
I do it all. I'm cutting the grass. I'm cleaning. I'm whatever. That's what I do.
That's what Eddie does too. You and him are the same. Mark says, people are losing money on their overpriced cars. Many are getting repoed. Yes, that's true. You know, one of the things that I always say is always look at the cars market. When there's a ton of foreclosures on cars, repo foreclosures, type, you know, same kind of thing. Sure enough, not too far afterwards, you start seeing homes increasing of repossessions. It's usually about 6 months after that. So if you're seeing a ton of repos, all of a sudden you'll see a little bit more foreclosures in the area. If you look at the statistics on that, it's pretty interesting. Have you ever noticed that when you're looking at trends and charts, or if that's something you never compared?
No, I do look at that. I think the big thing about cars especially over the last couple of years of the pandemic, man, look, my son got in an accident and somebody totaled his truck, guy hit him. And the price that we got for the truck, I was like, there's got to be a mistake here. But it was going back to they weren't making a bunch of cars. Prices were. So I think you're going to see a lot of that because of the price of automobiles over the last couple of years has gotten insane. Okay. So I think that is a great point for bringing that up. And yes, when you start, but going back to what we just talked about, think about it. Jobs, cars, all this, the price, what goes up, it's got to what? It's got to come down. So I'm not going to sit here and tell you that you're not going to see a pricing increase in the housing market in some markets. But I am going to tell you is that the price of rent is not going to have this huge decline. Therefore, you're always going to have people that are like, man, look, I'm tired I have this conversation at least one time a day of a client calling me saying, I am tired of renting. The price that I'm paying is absurd and I'm done. I'm ready to go buy. So, but that's a great point about the used cars and cars in general.
I always say I'm tired of living in unprecedented times.
There you go.
Like every time they're like, this unprecedented time story, I'm like, no, it's not even unprecedented anymore. It's just everything can happen. Yep. Anything. Who cares? That's right. Anonymous user says, if I'm going to close to, if I'm close to paying off my house, would you recommend buying a second house as an investment?
Well, so let's classify that. Second home. If I was going to buy a second, I would ask the question this way. The house you're looking to buy is going to be an investment property or a rental property. Mm-hmm. Now, if you go buy a rental property, the interest rate on that rental property is going to be higher than the interest rate on your primary house. What I would tell you would be is let's look at possibly the opportunity of borrowing the money against your primary house, which is going to be at a lower interest rate to where you could have more of a profit margin or spread on this investment property that you're speaking of. That's what I presume you're talking about. Second home kind of gets mixed in. Well, I'm going to get a second home and investment property. Well, which is it going to be? Is it going to be a second home like on a lake, or is it really truly going to be an investment property that you're going to rent out? Either way, I would say look at pulling some of the cash out on the primary residence that you have if you're in a great equity position, because you're going to get a better interest rate, and that's going to make that new property cash flow much better for you.
You've got a lot of real estate agents in this chat, and some of them really love your accent, by the way.
Oh.
Rebecca Valera has said that she liked your accent.
Oh, thanks.
So V-Man has a question. He says, just an idea. What if first-time home buyers will pay half of what the interest is? If it's like 7, they could get a 3.5 only for first-time home buyers.
What? I'm not sure I understand that question.
Well, I think maybe he's saying like if there was a product just specifically for first-time home buyers, like you've never had a mortgage before. You've never had a mortgage before in your lifetime. So because this is your first house, you get a 3.5% interest rate when the actual interest rates are 7%.
Well, look, I'm going to talk to first-time homebuyers real quick, guys. There's products out there right now that blow my mind. I mean, you can buy a house today in this current market with no money out of pocket, a rural development loan, or even a down payment assistance loan with no money out of pocket, which again, I'm the guy that's going to tell you, I want you to buy, but I want you to have a little bit of a nest egg. But there's so many different products and programs. If I'm walking into a house with no and potentially no money out of pocket, and that rate's at 7%, but I didn't put any money out of pocket, I feel like you're getting a very, very low interest rate, to be honest with you, because you didn't put anything out of pocket, right? It didn't cost you anything. So I would just, we all key in on interest rates. And look, I'm a frugal dude. I count every penny. But at the end of the day, I always tell people, what are you paying now? What do you think's affordable for your situation? And let's see where it is. Do I think that could be something that could help? But you're not going to lower the payment that much. Like lowering the interest rate a half a point might lower the payment on a $240,000 house, 80 to $100. That's not enough to make that buyer buy. Lowering the rate 2 points, like 2 points on a $250,000 loan could be almost $400 a month, 300, 200.
That's a lot of money.
Yeah, that's a lot of money.
Mm-hmm.
So I think knowing going back to experience matters. Let's figure out what we need to do to structure the deal to get that person into the house, because what I just said, it's a season. These rates, what we're looking at today, will not be the same rates in 6 months or a year from now. But if you gained 4% a year on your money over the next 5 years and you're up 20 or 25%, you're a hero. We're a hero. We work together to get you into something. And if you don't like it, then you're going to sell it and you're going to make the money that we just showed on that buy versus rent calculator. So I think you just got to get with somebody, let them run the numbers. Hopefully it's me. I'll be happy to have a conversation with anybody about it, but let's look at it. And if it's not right, it's not right. But
all right, go ahead.
No, but that was it.
Okay. We got another question. It says, I qualify for a direct version of the USDA loan with Universal Development Loan, around $120,000, and have $23,000 cash. Any tips on what direct USDA allows for in square footage, condition, and age?
I don't have any tips on the back half of that. What I would say, great job on saving up that amount of cash. That's fantastic. I would definitely look at credit, and I would hold on to my cash, and I would use any product out there that I could put the least amount of money down. If I went back and I said, hey, look, go to American Express. I'm not promoting them, but they have a high interest yield credit account right now, paying almost 4.5% or 5%. Most of your banks are paying that. Put that money up, let it make some money for you. Go put a minimal amount of money down, let the appreciation ride up. You're in great shape. That's fantastic. Most people buying their first home don't have that type of money saved up. So fantastic job there is what I would say.
There isn't much that rural development says absolutely no to, unless it's not like it doesn't have functioning electricity and it doesn't have functioning well. They'll say no, but they're pretty good.
They're very good. The biggest thing that they do say something about is your income. So they have tight income limits. Outside of that, they are very lenient, and they've done a fantastic job on getting people into homes. GMFS, company I work for, is the largest rural development lender in the entire Gulf South region. So we do a ton of them.
Nice plug there. Good marketing. I know, I'm just messing with you. What's your thought about the Canadian housing? Oh my gosh, I was just reading about this. So, like, it's really strange to me how similar, like, as you go across the globe, that housing markets are very similar, like as far as a whole. Canada's having the same problem that we have. Actually, Canada saw it before we did, with the institutional investors, foreign investors, causing home prices to go up exponentially. I mean, they have the same issues that we have. If you go to Australia, they have a limited supply because they don't have enough room to expand, because infrastructure stops. Basically, you see a line in the sand, no lie. You take a drone, throw it up in the air. There's sand on one side and buildings on the other, and there's no infrastructure beyond that. So all the homes in that specific area are very expensive. There's always lessons to be learned from watching other real estate markets throughout the world. but we're not unique. There's nothing special about the United States housing market that can't be seen somewhere else. That's for sure. But yeah, I keep my eye on Canada all the time. Years ago, I had this guy Brad McCallum on my live stream, and I was asking him about the foreign investors that had come in, and they actually made a law in this one province that you couldn't have vacant property, because what was happening was they had a large amount of Chinese investors come in, buy houses, and leave them vacant. They were just basically holding on to them like they were stocks. They would, maintain the yard and everything, but they would keep the home vacant. They'll penalize people for doing that. You can't have, there's such a lack of housing, such a lack of supply. You're either going to rent it, sell it, or you're going to pay. And so they were like, oh, so that helped a lot with
Nice.
some of the housing. So it's not necessarily a bad idea. Eddie, do you have any other questions you can put up on the screen? My love, Eddie, my love. If anybody doesn't know, Eddie is my producer. He's in the background. He's also my husband extraordinaire. Clark, the realtor. Gotta say that right. I have a client that wants to sell but won't get what they bought it for. What do you think about them doing a triple net lease on their property?
I think at this particular moment, based upon the, the limited amount of inventory out there, I think I don't have a problem with them leasing the property out
No.
until you can get back to where that everybody's in a different situation, right? And so people even ask me, so Ryan, that like this property you're selling, why are you selling it? It just doesn't fit into my little portfolio. So if this case here doesn't work for them to sell it, then lease it out. And then when things rebound and you can sell it and be to the positive, then do that. I don't have a problem with that at all. I think that's a creative way of doing what you need to do.
My husband and I, we've been in several different types of financial situations.
Sure.
And when things got desperate, I was a creative financing queen.
There you go. I think it's great.
I have made it every single time. I'm like, after I got done, I was like, that sucked, but man, I'm a genius.
Yeah, absolutely. Absolutely.
I got it all put together. Lawnmower says, are owner finance sales increasing? I have not seen it here.
No.
I haven't seen it here.
No. So the only way an owner financing deal really makes sense and is if the borrower or the person looking to purchase has a decent amount of money to put down, right? And I'm decent meaning 15 to 20% to put down.
Right.
I would be very careful. I'm always careful to say owner financing, you got to make sure that you know the terms. You got to make sure it's recorded. You got to make sure all of those things, like it needs to be done on the table in front of a notary or in front of an attorney. But no, I have not seen very many of those. And in my career at different times, I've seen some, but right now is not that time because again, going back to the limited amount of supply and high amount of demand, that person's just going to be like, hey man, look, that's fine, but I'm going to get somebody else to buy it. So no, I have not seen that to be a big deal.
I saw lots of lease purchases during the last bump in the last time. There were a lot of them. And you know what? I have to tell you, I've only seen one lease purchase turn out correctly.
Yeah.
I've seen them go really bad, even when they put down that huge deposit. So I went on a brand new constructed house. The builder owned the house. They did a lease purchase. These people put down $60,000. Builder was like, whatever, fine, live there for a year. You pay X amount, we'll close this. So it gets closer to that year. These people trashed the house, trashed it. The pool was disgusting. I mean, it was like, I didn't know you could ruin a house that bad. And that's it. They lost that $60,000, but it cost that builder $60,000 to repair everything they screwed up between the pool pumps and air conditioning stuff. Like, who does that? There's some people that are just not right in the
not right. That's not right. That's not right. Nope.
No, it's not. Anyways, date the rate, marry the house. I hate that expression. It's like my least favorite expression. Do you like that expression?
I don't. I look. I get the concept. I think I always use the cliche. just understand and know the numbers. So like, just like every conversation I get on a phone call is, what's the rate and what's the closing cost? What's the rate and what's the closing cost? You have to be exceptionally careful on that question, because one of my biggest online competitors advertises a very good rate, but the closing costs are astronomical.
Yep.
It does. So if I'm not a ethical dude, I'll say my rate's 6%, even though everybody else is at 7%. But I didn't tell you that my closing costs were 3 times as much. But
Right.
I understand the concept. It does make me cringe a little bit, because what I always like to tell people is, let's look at the numbers. Let's make sure that the numbers make sense for your financial situation. If they
Right.
do, move forward. If they don't move forward. Right.
Mhm.
Right now, because of the increase, rates were in the 3s, rates went to the 7s. I understand psychologically, dude, 4 points, 4%. Are you crazy? But they should have never been where they were. 5.5 is a good number for everybody to win. You're going to see absorbent amount of appreciation. 7, 7.5, 8. That's not necessary. It all works at that mid 5s, upper 5s. Let's move forward. That's my thing. But I understand it. I just, when I hear it, I'm like, let's look at that situation for that particular client. Let's figure out if it makes sense for them to do it. That's all.
Yeah, we got a question that says, why do you have to take a property out of a trust and to get a construction loan? The trustee is responsible for the payments. Why?
Well, you
I think every area is going to be different too. That's not necessarily true for each state, is
it's
it?
not true for every state.
Correct.
But the big thing is, like, Fannie Mae will not allow you to close in a LLC or in a trust. But getting
Okay.
a construction loan is different than when you turn it to permanent financing. So
Okay.
some construction loan companies or banks that do the construction loans, how they allow you to do it and how they make you turn it into permanent financing, two different things. But you're exactly correct. Every state is different. So I don't want to speak in general. I just know that you don't have to do that in all states. Some states
Mhm.
will allow you to close in a trust and LLC and things of that sort. But that's my
Right.
take on that.
Right. It's going to be different for every
Yeah.
area. Is there a downside to paying off my mortgage? They keep changing my mortgage servicing company despite no late payments. Makes me uneasy, and none of the dollar is going towards my principal. None of the money is going towards your principal. I don't know how long you've had your loan. So at the beginning of your loan, it all goes towards interest. At the end of your loan, it's going more towards your principal.
Yeah,
And you can
sure.
actually pay a separate payment towards your principal.
There you go.
And
There you go.
I've changed service. Like one of my loans for my last, not this house, but the last house before that, every time I turn around, they were changing servicing companies. I think it changed 6 times in 1 year. It was ridiculous.
Yeah, so we do service all of our loans, which has been huge for us. It's a big risk. But what I would say about paying off your mortgage, again, going back to what's important, let's look at the rate. Let's look at, if I go pull X amount of money out to pay off a mortgage that's an appreciating asset that I'm only paying whatever 5% or even 6%, but I could put it in a fixed account and make that. I would say maybe change mortgage companies, but don't pay. I'm cool with you paying it off if it makes financial sense. If it doesn't make financial sense, make a move to get away from that mortgage company with another mortgage company. And I guarantee you that issue would probably go away anyway. But that I wouldn't just say pay it off for that reason only. Let's look at all the financials and see if it makes sense to pay it off. Like people that have a 2.5 or 3% interest on their mortgage, why in the world would you pay that? Why would you go pull money out and pay that off when you've got money over here making X amount? That to me, when people tell you, look, everybody's got different advice, but I always say, let's look at the numbers. Do the numbers justify us to do that, or is it an emotional decision to do that? I don't know.
Quick question says, how much land on a property does USDA rule allow? How much land on a property? How much land does USDA is like acres of land, right?
Well, that's USDA is typically rural
Oh.
development loan. But what I always say is typically you have to look at the house in up to 10 acres. That's
10
typically
acres. Okay.
what they will allow you to give value to. They're not going to say, hey, they have a 800 square foot house on 30 acres and you're going to put all the value on the 30 acres versus the 800 square foot house. That's from a financing standpoint, they're not going to allow that.
That's a good question. I learned something new today. Thank you, Ryan. If people wanted to get a hold of you, Ryan, how are they going to do that?
Absolutely. Absolutely. I'd love to talk to them. I'm kind of, because of Kristina, I'm starting to get out there a little bit, but I'm on all the social channels and things of that sort, starting to be. But you can call me at 225-214-5153. I'm with GMFS Mortgage here out of Baton Rouge. But again, I do business in about 11 different states, I think, at the current moment. So I'd love to have a conversation with you. Hit me up, whatever I can do to help and add value. I love speaking to people, just educating them. And Kristina and Eddie, thanks so much. It's been fantastic. I love spending time with folks, just talking about different things that come up. And again, giving good, solid, true information, not just, hey, that sounds good, that's sexy. Let's talk about something that somebody's been doing it for a long time. Kristina, I know you've been in the real estate market forever in a lot of different markets, myself as well. I think that that's important because you don't see that.
Right. Well, if you guys need to get a hold of me, you can always get a hold of me by going to my website at KristinaSmallhorn.com. All you do is click on one of the pink links and put in your information, and I'll give you a little ringy ding 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 and give you a call and talk to you about your real estate needs, especially if you need a real estate agent across the country. I happen to be connected with thousands across the country. If you're also interested in listening to this as a podcast, you can find me anywhere you listen to your podcasts. That's it. Just type in my name, Kristina Smallhorn, Real Estate for Everybody, and there I am. All of the past live streams that you have on that I have on this channel are also as a live podcast on any social media site that you'd get your podcast from. So isn't that fantastic, Ryan?
That is fantastic. She has done an amazing job. I'm so proud of you. Have a great trip on your, when are you leaving? When you head out?
Yeah, thank you for telling me that. So next week, we'll still be here next Sunday. I'm going to be here with Sir Ashley. He's out of South Carolina, or maybe it's North Carolina now. He's moved. So it's one of the Carolinas. He's there. And Sir Ashley's coming in. But right after that, I'll be in Texas. So I may not be there the week after that, but we'll get into that. So I'm going to Dallas, Texas. Anybody that's in Dallas, Texas, not this week coming up, but the following week, I'll be at the convention center. Maybe we can meet up and say howdy and get a little selfies together. Because I like my peeps. I want to put you on my Facebook page. Maybe put you in the community page on my channel here. That'd be awesome. It would be awesome. So, Ryan, I want to thank you so much. You always are keeping us informed whenever the Fed meets. It's always a time for anxiousness, especially when it comes to the housing market. And I always like to hear your perspective. Thank you so much for being a part of the stream today. And thank you, everybody that came in. There was over 400 of you. I appreciate every single one of you spending over an hour with us talking about the Fed and what's happening with mortgage rates. That's always not necessarily the most exciting thing, but I always appreciate the time that you are willing to spend with me to talk about these things. And I want to say thank you to all the moderators that kept the chat clean. I did see the things we were getting a little wild there at the beginning. People started getting real political. We don't do political. We'll talk political policies, but I don't give a flying flip who you vote for. This ain't this channel. So let's not do that here. Anyways, I appreciate all my moderators. Thank you so much. And thank you to our super chatters. All right, everybody. Next week, if you have an idea that you would like to talk about between me and Sir Ashley that's out of the Carolinas, just let me know in the comment section after this video is published. All right, everybody. Have a great week.
Thank you.
So long. Farewell. Avita Zane. Oh, he just took off, man. So I was gone. He was done. He wasn't going to wait. He was no dancing involved. He just left. Deuces. Here we go. Here we go. We're going to do a dance. He may not dance, but Kristina danced. Oh, I like this song.